Welcome to Under the Basswood Tree podcast with Basswood Counsel. We break down the latest in tax law, cross-border deals, and M&A to help you build and scale your business with confidence. From international tax planning, developments in AI governance and regulations, to venture capital trends, each episode delivers focused insights you can use. Let's get started.
If you live, invest, or operate across borders, U.S. reporting obligations extend beyond just filing your tax return. Two regimes come up every year, and that's the FBAR and FATCA. They are related, and often overlapping, and frequently misunderstood. This episode explains what the regimes are, how they work together, and what some of the pitfalls are or confusions around how they operate. So, I'm Rudo Mugwagwa. I work with the corporate team at Basswood Counsel, advise on investment funds and their full life cycle, and that includes dealing with their regulatory compliance issues. Today, obviously, we're focusing on the FBAR and FATCA, and I'll be talking about the FBAR.
All right, so I'm Gina Lee, and I'm part of Basswood Counsel's tax team, and I'm going to jump in right ahead into FBAR. So FBAR stands for Foreign Bank Account Report, and that has been in existence actually since 1970 when it was enacted as part of the Bank Secrecy Act. The original purpose of the BSA was to help identify transactions that might indicate money laundering, tax evasion, or other criminal activities through the FBAR reporting. So you have to understand that the FBAR is not a tax form, but rather a reporting form for the Treasury Department's Financial Crimes Enforcement Network, FinCEN for short, which has since delegated the enforcement authority to the IRS. And while the law existed for decades, nobody really knew about the FBAR obligations, and aggressive enforcement by the IRS only became a priority after 2009 when the IRS launched various offshore voluntary procedures. They actually had multiple ones, the multiple offshore voluntary disclosure programs since 2009. And that's when FBAR also became more of a priority. So what is FBAR and who is required to file this FBAR? FBAR essentially requires U.S. persons to report their bank accounts held outside the U.S. So if a U.S. person has a financial interest in or signature authority over non-U.S. financial accounts, that person, who is the owner or title holder of the accounts, has to determine whether the total amount of the maximum values of all these accounts that are held outside the U.S. in the aggregate exceeds $10,000 during a calendar year. If that $10,000 threshold is met, then that person must file an FBAR reporting all of their accounts for that particular year. So a couple of things to remember where you have to look at the maximum value for each account, not the end of the year value. So let's say that you transferred money into your foreign bank account, like $100,000 at some point in the year. The maximum value of that account for that year was, $100,000 or more if it already had a particular balance. So you have to pay attention to look at the maximum value that the account had. And then the other thing to remember is U.S. person doesn't just mean individuals. It also includes companies like U.S. corporations, partnerships, and also trusts and estates that are formed under certain states' laws of the U.S. So it's U.S. persons include, just wanted to highlight that, individuals and entities. And when a U.S. person is the sole owner of financial accounts held outside the U.S., it's easy. Are the sole owner, you report them on the FBAR. So what if you have joint accounts? So let's say that you hold a joint account with your spouse who is a non-resident alien of the U.S. Then you still have to report all of those joint accounts on your FBAR. And then the other instance wherein a financial interest in foreign accounts can arise is through ownership of foreign entities. So if a U.S. person or individual owning directly or indirectly more than 50% by vote or value of the stock in that corporation, or it could be a partnership where the partners have more than 50% profits or capital interest, then that U.S. individual owner, shareholder or partner with control over the entity also has the obligation to individually report the accounts held by the corporation or partnership on their individual FBAR. So let's say, for example, if a U.S. corporation has, just for simplicity, 100% owner with full control over the company's operations and bank accounts, and the corporation has accounts in Germany. So both the U.S. corporation has to file the FBAR, and the U.S. shareholder also, as an individual, must file an FBAR. So, what are the types of accounts required to be reported on the FBAR? I think all foreign bank accounts offered by financial institutions, like most of the cash accounts, checking or savings accounts, investment accounts, brokerage accounts, even the accounts maintained within a branch of a U.S. bank physically located outside the U.S. are considered foreign bank accounts that need to be reported on the FBAR. What's important to note is insurance policies, annuity policies with a cash value, and have your own separate account. Those also need to be reported on the FBAR. The other thing that I wanted to mention was the foreign mutual funds account and similar pooled funds, such as foreign pension accounts that have your separate account number, also need to be reported on the FBAR. So I say that if you are in doubt, just report them on your FBAR. FBAR is an informational report and does not have any tax implications, so it doesn't hurt to over-report. And when it comes to value as well, I talked about the maximum value that needs to be reported. So, if you're in doubt, just over-report. So if you think that, maybe the maximum balance was maybe $50,000 or so, you can always report $70,000 was the maximum value that the account had. It doesn't hurt to over-report.
So, Gina, what would you say some of the pitfalls are that you see in this reporting process for the FBAR?
Yeah, so a couple of things that I wanted to note was when it comes to joint accounts held with a child, for example, it's not uncommon for a parent to add a child to their accounts, or the parents add themselves to the child's account. And then in both instances, actually, the child is the joint owner who also has the obligation to file an FBAR if that child is a U.S. citizen. So remember, there is no age limit for the FBAR. So that child, whether the child is 5-year-old or 10-year-old or 15-year-old, the child also must file its own FBAR. The other thing is FBAR carries large penalties for non-filing. So that's why when you're in doubt, just report everything that you think you have and then file it on time. Non-willful failure to file penalty can be as high as $10,000 per year. And for willful failure to file penalty, it's a defined term. What willful means can be determined by the IRS in looking at various situations and circumstances. But if they find you that you willfully failed to file this form, they can apply both the civil monetary penalties and criminal charges. So the monetary penalty can be the greater of $100,000 or 50% of the highest balance account at the time of the violation. And on top of that, the IRS can do criminal prosecution, which may result in fines of up to $250,000 and then imprisonment for up to 5 years. So
that's pretty steep.
Yes. So
the consequences of not complying are pretty steep for people. So what I've gathered from this is that you're saying the FBAR is about visibility and control and not tax or income, right?
Correct.
So IRS funding.
Correct.
So that's the main takeaway you would say people should take from this presentation, from your analysis of what's important about the FBAR, making sure that you actually can file the report. And it's better to be safe than sorry. So make sure you include information that you yourself might not be sure needs to be filed, but it's better to be safe than sorry.
Yep. So FBAR is a simple form, so remember to file it. But this is a form that U.S. taxpayers have to file. But we have, FATCA regime, which Rudo is going to get into, which requires obligations on the financial institutions. So I'll turn it over to Rudo on that.
Yeah, so FATCA often gets talked about in the same breath as the FBAR, but it operates a bit differently. And at the level that we mostly work with, FATCA affects entities and financial institutions, not just individuals. So what is FATCA? FATCA is a U.S. regime codified under Chapter 4 of the Code, and it specifically looks at financial institutions having to identify U.S. persons and reports account information on those US persons. So this means they will take a look at what your account has, whether it's an account for foreign shares, securities, interests in foreign funds, and certain ownership interests in foreign entities. This regime works in tandem with intergovernmental agreements, right? When you're talking about the financial institutions, you have to look at the intergovernmental agreements that jurisdictions have with the US. So for Model 1 intergovernmental agreements, these entities report directly to their local authorities this account information on US persons. And their local authorities have the responsibility of then relaying whatever is reported to the IRS. At a local level, they implement the necessary legal instruments, right, to enable these institutions at a local level to report to the IRS. For Model 2 jurisdictions like Japan and Hong Kong, it's a small number of countries that fall under the Model 2 IGAs. These entities do not have local authorities reporting on their behalf. They have an obligation through an FFI, Foreign Financial Institution Agreement, to report directly to the IRS. This is done through a portal called the FATCA portal, which you register under as an institution. You're senior. Usually, this is done by senior management. They will register on the FATCA portal to obtain what we call the Global Intermediary Identification Number, or the GIN number. And through that registration process, they enter the FFI agreement, where they agree to report this information directly to the IRS. They agree to comply with all the requirements under FATCA, where they're required to do the necessary due diligence to identify the US accounts by taking a look at all the account holders and going through a due diligence process to identify, are they a US person or are they not a US person? And then taking a look at the account balances, right, to determine if they are reportable or not. This is something that we support clients through during the reporting cycle, which aligns quite neatly with the tax filing deadlines, right? The deadline for FATCA reporting is March 30th. And overall, I think people get a bit confused around, okay, how do we know, right? If we're an institution, how do we know which of our account holders need to be identified when we submit the report? So to answer the first question, financial institutions include depository institutions. They include investment managers that manage accounts on behalf of other people, right? And they include investment funds, right? When you're taking a look at which accounts are reportable, right? They're looking for accounts that are held by the defined US person. So US citizens, US residents. And I think that's where people get the confusion, right? That if you're living abroad, then it doesn't matter, you don't fall in scope, but you need to do that analysis to make sure that you are not falling within the definition as it is under US FATCA, right? And that's something that we can work with you on. And then you have the other side of that, where you have passive non-financial entities, right? And these are non-financial entities that don't conduct any active activity. So a lot of their activity is passive. More than 50% of their activity is passive. You would look through to see who the controlling persons are. And that's how you figure out whether these account holders are reportable. You look through and see if they have any U.S. controlling persons. FATCA is a minefield in terms of definitions. And so I think people get a bit frustrated because they have to go through a process of going through definitions a lot of the time to make sure they've properly captured which people are not reportable. I think one of the things people also assume is that under FATCA, it's only financial institutions that fall into scope. But we know that FATCA also applies to individuals. Right, Gina? I think this is one of the things that you experience when helping people with their FBAR and their annual standard tax filings.
So we often do not hear as much about the FATCA-related tax filings required by individual taxpayers. So U.S. individual taxpayers must also file Form 8938, which is called Statement of Specified Foreign Financial Assets, which is also part of the individual's tax returns. So FATCA compliance for individuals commenced with the 2011 U.S. tax filing. So it didn't start with the FBAR reporting, but then after the FATCA regime kind of got created, they also require individuals, so not just the financial institutions, but also require the individuals themselves to report about their accounts held outside the U.S. So there are certain filing thresholds that require the taxpayers to file this Form 8938. It is part of their tax returns. And the reporting thresholds depend on the filing status and whether the filer resides in the U.S. or outside the U.S. I'm not going to get into the details of it to make it more boring, if not boring already. But essentially, what I wanted to highlight was FBAR and Form 8938 require similar information to be reported. So, as I mentioned, FBAR requires reporting on foreign financial interest in foreign bank accounts, essentially. So Form 8938 also require reporting of foreign financial accounts. The key difference is that Form 8938 requires reporting certain foreign assets that might not be held in an account. So some examples are, the shares of foreign corporation, interest in foreign partnership, interest in, foreign pooled investment vehicles like the mutual funds or hedge funds or private equity funds. Those are all instances where you might not have those interests through a particular bank account, right? Like a brokerage account. So those assets may not need to be reported on the FBAR, but then are required to be reported on the Form 8938. The other difference is FBAR requires reporting on accounts where you have signature authority. So that makes you not an account holder in these accounts. So you could be like an officer of a corporation and, you're not really an account holder, right? And your interest in that company is less than 50%. Still, because you were like an executive or a high-end official of that company, because of the reason you have signature authority over some of the bank accounts held outside the U.S., then that also makes you required to file an FBAR and report these signature authority accounts. And just wanted to highlight that, for Form 8938, we said you need to report all your foreign assets. Foreign real estate holdings, however, that you hold directly are excluded from being reported on Form 8938. So, the residence that you own in Germany or in the UK, you don't have to report it on Form 8938. And Form 8938 also has a similar penalty regime, so it may result in $10,000 penalty per year if you don't file it on time, unless you have reasonable cause for it. And then there could be criminal penalties for non-filing. The failure to file was willful.
Yeah. There's a lot of crossover, right? Accounts that you have authority over obviously aligns in a way with the controlling person's requirement, right? For financial institutions that are passive, right? The passive non-financial foreign entities. They also, it's a similar threshold, but at an individual level, right? And even when you're looking at the consequences, right, of non-compliance for entities under FATCA, we know that if you fail to file, it's not an immediate penalty. However, the IRS will take that extra step to try and contact you to get the information. If you fail then to provide the information, they have a period before they actually go on to then impose a 30% holding, right? 30% the tax withholding, which we know a lot of financial institutions, for funds at least, we know that holding can have terrible effects on the wider fund, right? Because not everyone is a U.S. person and required to report, but they will feel the impact, right? Whether it's now, fund might have issues with their banking, the reputational harm, the potential tax leakage to the other investors in the fund. These are all things that we know people try to make sure don't happen when it comes to FATCA. But we know that there is such a thing as a reclarent account, right? These are accounts where the institution has attempted to obtain information from the account holder, whether it's their verification that they are not a U.S. person or that they are a U.S. person. If they fail to get this confirmation, then these accounts can fall into the category of reclarent accounts, right? And those recurrent accounts falling within the category of accounts that the IRS will have to follow up with the local authority with, right? Because the financial institutions cannot disclose information that they do not have, right, on these account holders. And for a lot of jurisdictions, especially now with data protection requirements, they cannot share information without consents. So if there is an instance where account holder has not provided consent to share information with the authorities, they cannot disclose any identifying information, right? They can only disclose balances. A lot there that you see that's consistent across the FBAR and US FATCA, right? Because ultimately they're trying to just obtain information on their U.S. persons that are outside or that have assets outside. And a lot of this stuff they would have reported at a local level. And this is an additional way for them to essentially corroborate filings that these people would have already done. So it is a challenge. And at Basswood, we try to always be thinking of our clients to make sure they're always thinking of what's next, right? And that might just be a simple compliance issue and us staying on top of it for you to make sure that you're always compliant or always thinking about the future.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.